Welcome to our deep dive into Navitas Semiconductor, ticker symbol NVTS. Today, we're dissecting a classic high-risk, high-reward stock that's captivating both Wall Street and retail investors. What if there was a tiny, under-the-radar company at the heart of the three biggest tech revolutions: AI, electric vehicles, and renewable energy? This company's technology is key to making everything faster, smaller, and dramatically more energy efficient. And their biggest recent partner? None other than AI kingpin, NVIDIA. Some see a path for Navitas to become a 10-bagger, a tenfold return on investment over the next 5 years. But others see a company burning through cash with giant competitors breathing down its neck. So what's the real story? Today we're doing a deep dive into Navitas, breaking down the technology, the massive market opportunity, the huge risks, and whether it truly has what it takes to deliver those exponential returns. Stick around. To understand why Navitas even exists, you first need to understand the problem with the technology that has powered our world for the last 50 years. Silicon. Silicon semiconductors are the foundation of modern electronics. But in a world demanding more and more power in smaller and smaller packages, silicon is hitting a physical wall. It's slow, it's bulky, and it wastes a ton of energy as heat. Think about it. AI data centers consume enormous amounts of power, and the heat they generate is a massive problem. Electric vehicles need more range and faster charging, but heavy, inefficient power electronics are a hurdle. And we all want smaller, faster chargers for our phones and laptops. Silicon is the bottleneck. To take the next leap forward, we need a new generation of technology. This is where Navitas comes in. They are a pure-play company focused exclusively on next-generation power semiconductors built from two materials: gallium nitride, or GaN, and silicon carbide, or SiC. Here's why that matters. Navitas's GaN fast power ICs can switch up to 100 times faster than silicon. This high speed allows for much smaller components, leading to up to a 3x increase in power density. That means a charger that's 3 times more powerful in half the size. This technology can cut energy waste by up to 40%. For an EV, that means more range. For a data center, it means lower electricity and cooling bills. But here's Navitas's secret sauce: integration. Unlike many competitors who sell individual, discrete chips, Navitas builds a system-on-chip. They monolithically integrate the GaN power transistor with the control, drive, and protection circuits all onto a single piece of silicon. This integrated design is easier for customers to use, more reliable, and unlocks the full speed potential of GaN technology. This is their key technological moat, protected by over 250 patents. And they're not just a one-trick pony. In 2022, they made a brilliant strategic move, acquiring a company called GeneSiC. This instantly gave them a best-in-class portfolio in silicon carbide, which is perfect for very high-power applications like EV powertrains and solar inverters. This makes Navitas the industry's only pure-play company focused on both next-gen power materials, allowing them to offer the perfect solution for any application. So Navitas has the technology, but how big is the market? In a word, colossal. The combined market for GaN and SiC power devices is projected to grow from around $4 billion today to over $20 billion by 2030. Navitas currently has only about 2% of that market. This tiny share of a giant, exploding market is the core of the 10-bagger thesis. If they just maintain their 2% share, their revenue could 5x from 2024 levels. If they can leverage their tech lead to capture 10% of that market, their revenue would skyrocket to $2 billion, which would almost certainly send the stock up more than tenfold. And this brings us to the biggest news in the company's history. In May 2025, Navitas announced a collaboration with NVIDIA. NVIDIA, the undisputed leader of the AI revolution, has selected Navitas to help develop the power architecture for its next-generation AI data centers. This is a monumental validation. It's NVIDIA telling the world that to power the future, you need the efficiency and density that Navitas's technology provides. This partnership is a potential inflection point that could unlock exponential revenue growth for Navitas. Okay, the story is incredible. But what do the numbers say? This is where the risk becomes clear. Navitas is in a classic high-growth, pre-profitability phase. While they've shown explosive revenue growth in the past, often over 100% year-over-year, that has slowed dramatically in recent quarters due to a wider industry inventory correction. The key takeaways are, they are not yet profitable. The company has consistently reported GAAP net losses as it invests heavily in R&D. This is a primary risk. Navitas is burning through its cash reserves. In the first quarter of 2025, they used about $13.5 million in cash from operations. They have a strong balance sheet with very little debt and about $75.1 million in cash. But at their current burn rate, that gives them a runway of about 5 to 6 quarters. The clock is ticking. Management knows this and has recently pivoted to aggressive cost control to extend that runway. The entire investment thesis hinges on their ability to turn their massive $2.4 billion customer pipeline and the NVIDIA partnership into actual revenue and positive cash flow before the money runs out. Navitas isn't operating in a vacuum. They face intense competition from semiconductor giants like Infineon and Texas Instruments. These companies have immense scale, deep pockets, and long-standing customer relationships. Compared to them, Navitas is a small, unprofitable player. Its main weakness is a lack of scale. It's also a fabless company, meaning it relies on partners like TSMC for manufacturing, which introduces supply chain risks. And there are other red flags. There has been a significant amount of insider selling from executives over the past year. While some of this is from pre-arranged trading plans, the high volume is a point of concern. The risks here are substantial. Execution risk. Can they actually convert their pipeline into sales profitably? Financial risk. Will they burn through their cash and need to raise money, potentially diluting shareholders? Competitive risk. Can they maintain their technological edge against giant rivals? So, is Navitas Semiconductor a 10-bagger in the making or a speculative bet doomed to fail? The truth is, it's both. The potential is undeniable. Navitas has a disruptive technology, a massive addressable market driven by the unstoppable trends of AI and electrification, and a game-changing partnership with NVIDIA. However, this potential is matched by very real risks. The unprofitability, the cash burn, and the powerful competition cannot be ignored. For Navitas to succeed and deliver that 10x return, it needs near-flawless execution. They must translate the NVIDIA partnership into massive revenue growth, control costs to achieve profitability and positive cash flow, and stay ahead of the competition with their integrated GaN and SiC solutions. An investment in Navitas today is not a bet on its current performance. It's a high-conviction bet on its future. The path will be volatile. This is a speculative growth opportunity that is only suitable for investors with a high tolerance for risk and a long-term horizon. The story is incredibly compelling. The risks are equally stark. Do your own research. But Navitas is without a doubt one of the most interesting and potentially explosive stories in the market today. What do you think? Is the NVIDIA partnership enough to guarantee a rosy future? Or is the cash burn too big a risk? Let me know your thoughts in the comments below. Don't forget to like and subscribe for more deep dives into the tech stocks shaping our future. Thanks for watching.